Good to have you with us. A new narrative in the oil market after weeks of worries around economic uncertainty and a demand picture that was uncertain. We have seen WTI surge today by more than $5 a barrel. We're above 80 bucks US. And now all of a sudden, some people are saying maybe $100 oil should be back on the table after a very surprise move by the OPEC Plus nations over the weekend to cut basically 1 million barrels a day from production. The White House responding by calling the decision ill-advised. Let's get the market reaction. Andrew Lipow has been covering this sector for many years. He's president of Lipow Oil Associates, and he joins us now. Andy, what was your reaction to this news?
Well, this is certainly a big surprise for the oil market, myself included, because I expected that OPEC was going to continue to stick with its October 2022 agreement of maintaining production cuts through the end of 2023. Those production cuts were from their quota of 2 million barrels a day. So what we're seeing today, I think, is OPEC Plus trying to actually get closer to their actual production levels.
And what do you think, as you do that math, what does that look like?
Well, it looks like OPEC Plus has failed to reach their production quotas by about 900,000 barrels a day. This voluntary production cut would get them certainly in balance to that. Meanwhile, we still have to contend with Russia announcing their production cut of 500,000 barrels a day through the end of this year. But Russia was already under their production quota by about that much. So I don't expect much of an impact from the Russia part of this announcement.
No, it's interesting. I was talking about how the sentiment has shifted among energy investors. Although, look, we have a chorus of optimists who came on throughout the first quarter explaining why they thought there was a reason to be bullish about this group. But, you know, the calls for $100 oil, they slowly evaporated by the end of the first quarter. This morning, all of a sudden, it seems like some people are putting that back on the table. Where do you see prices headed now?
Well, I'm expecting that OPEC Plus wants to see Brent crude oil at about $90 a barrel, which means that WTI would be $85 a barrel. I think they're still concerned with economic developments, especially with the banking crisis impacting on consumer spending or business activity that could dampen oil demand. So they actually have taken a preemptive step, you know, in that direction in order to prevent a collapse in oil prices that we've seen in previous years. What it also means is that OPEC Plus is really concerned about their total revenue and their domestic budget spending.
Now, I mentioned the frustration that the White House has already expressed on this, and this, look, we were talking about this earlier, there are always political complications when it comes to the story of oil's ups and downs. But it is very interesting, just given how much of a hot button issue gas prices have been in the U.S. And certainly here in Canada. The efforts that the White House took to tap into the strategic reserves. And even though maybe the inflation narrative is not as robust as it once was, there are very much, to your point, worries about where the economy goes from here and whether higher oil price is going to help or hurt that. So perhaps no surprise to see the White House express its frustration. Our Bloomberg colleagues, though, noting that the president may have limited options in how he responds to this OPEC Plus cut. What would you see as playing out from Washington as this story evolves?
Well, I think there's going to be a lot of comments against OPEC and perhaps a revival of that no-PEC legislation allowing the U.S. to sue sovereign governments for, you know, collusion and collusive behavior. But on a practical matter, there's limited options that the administration can do in order to lower gasoline prices, which is really the hot button political issue. We saw last year when gasoline prices hit $5 a gallon, the federal government was reluctant to waive the 18-cent per gallon federal excise tax, which is something that they could do. But really, the lower prices depend on higher amounts of supply. And what we have seen during the first quarter is weaker prices were really being impacted by revisions downward into demand. And perhaps OPEC Plus is now not so optimistic of the return of Chinese demand going forward.
That's an interesting point as well. Yeah, we had really chewed on that in the first weeks of the year as well. Kind of gets me back to the broader economic story. I mean, beyond just figuring out where prices are going or how the industry is reacting, Andy, I think that there is this broader narrative this morning, and we're seeing it reflected in, some of the standout stocks from the first quarter. Technology easing off a little bit because people are trying to figure out, gosh, what does this higher oil price actually mean for the economic outlook? What do you think?
Well, there's no doubt that these higher prices will contribute to higher inflation from higher gasoline prices, higher jet fuel prices, and higher diesel prices, which are reflected in all the goods and services that are delivered to the consumer. So from that standpoint is bad news. And you combine that with higher interest rates that impact on the general business activity, one can see why this dampens the economic spirit and ultimately could negatively impact on oil demand.
Yeah. What's the next chapter, you think? What do we have to watch for now that we are getting around this OPEC Plus decision?
Well, I think what I would be watching for is how much of these voluntary production cuts are actually implemented by OPEC Plus. And it's also interesting to note that these are voluntary cuts by a small group of these OPEC Plus members, which means to me that they probably couldn't get an agreement from all of the members to each contribute some production cuts. The burden is actually on Saudi Arabia for the majority of these cuts.